Hey, 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 we are back.
We are back investing in Huntsville.
Yeah, for better or worse, we are back with the Investing in Huntsville podcast, videocast with Zack Childress, Tim Knox. I am the realtor. He is the investor.
That's right.
And the expert.
And you know what I realized the other day, Tim?
What's that, bud?
You did this whole thing with me about how I got started.
Yeah.
But we've yet to hear how you got started.
Oh, God. Are you sure you want to go there?
Well, I just feel like, it's like, hey, you're on here, and I know a lot of people know you, but what about all the people that are coming in and watching this and going, okay, well, Tim's a realtor, but how did he become a realtor?
Who's this guy?
Yeah, how did he become a realtor?
Yeah.
How did he decide to build a brokerage, and how did he do all these things? So I know we want to talk about your buy box today and how to know what to look for before you start. But before we do that, why don't you tell us a little bit about you?
Wow. Who is Navin Johnson?
I just took over this
That was great. That's good, yeah. Real simple. I'm just kind of a lifelong entrepreneur. Had been in business here for, 35 years ago or so with different businesses. I was in the software business. I was in the gun business for some reason, but had kind of sort of retired and was getting on my wife's nerves. And she's like, you need a job, a hobby, or a girlfriend, and I will not tolerate a girlfriend. So that limited me tremendously, right? And so my daughter Chelsea was already in real estate, and she said, hey, Dad, why don't you get your license and build us a business? And so that's what I did. We started.
And how long ago was that?
5 years ago. We started Revolved Realty here 5 years ago in April. And so, I knew nothing about real estate. Chelsea had been in it a long time. She was doing retail. She was doing flips, buy and hold. She was in everything. It was really amazing at it. And I just did some research. You go to YouTube, how to be a realtor. Step one, are you sure you want to be a realtor? And so, we started the company here 5 years ago. And
so
we're doing
let
really
me ask
well.
this. So when you said you wanted to be a realtor, did I say that right?
Realtor.
Agent. When you said you wanted to be an agent, right? Did you go in and say, hey, look, obviously I'm an entrepreneur. I understand business. I understand how to start them. I understand how to grow them. So when you went into becoming an agent, did you go in with the idea that I didn't want to be an agent, I wanted to build a company?
Exactly.
Okay.
Yeah, and that was the thing, because I am not a great employee. Yeah. I had no desire really to sell real estate, although it turned out I was really good at it. I've been in the top 2% here for 5 years, but the plan all along was to start a company.
Gotcha.
I got my license. I did a lot of research about real estate because I didn't have a clue.
Right.
And so, we looked at different business models, and that was about the time that you and I hooked up when we first started Revolved with He Who Shall Remain Nameless in Athens. Yep. The whole plan all along was to start a company. So I got my license, hung it at a real estate company here that Chelsea is with for a few months while we figured out what we wanted to do. But it's really funny because the first 2 or 3 years, I didn't really build a business, because I was the rainmaker. I was the guy doing most of the sales. Right. I was so busy working in my business that I didn't work on it, as Kiyosaki would say, or Gerber, whoever it was. 2 years ago, we really made a shift in the company. And I went from being the rainmaker to actually running and building the company. And so in 2 years, we went from 8 agents to almost 100.
Well, and in those last 2 years, you'd have to have your eyes covered not to see what Revolved has done and grown to.
Well, we were number 15 in the market last year out of about 500 brokerages.
And you guys serve all of northern Alabama.
We do. We've got offices in Huntsville, Decatur, and Madison, but we've got agents all over North Alabama. So, we cover a wide swatch. And
so everybody should owe the success of Revolve to your wife by
for
not
telling me to
you
get the hell out of the house, and then to my daughter for going, hey, let's start a business. But what's really funny is I got a buddy here who actually owns a competing brokerage, and he had tried to recruit me into real estate like 2 years before I got in. And I remember this conversation, hey, meet me at Panera, let's have a cup of coffee. And so we're having coffee, and he goes, have you ever thought about going into real estate? And I'm like, are you crazy? Why the hell would I do that? I have no interest in. And then 2 years later, we got into it. And it's been a really good decision. Yeah. It's a different kind of business, as you well know. Yeah, it is, and a lot of interesting folks in real estate.
Ooh,
but we work. As a result, we've kind of gotten a reputation of working with investors here as well. And so that's kind of what, you and I have done a lot of business together, but every week I'll get 3 or 4 inquiries off the YouTube channel from investors out of state looking to invest here.
Yeah.
And I've been pointing them at our videos, which have been very helpful to them. So, but yeah, here I am.
There you go. Well, so I just felt like I needed to honor that back because I went back and watched our videos too. And I was like, he never told us how he got into where he is today.
Yeah. Well, it's one of those things, honestly, a year before I started the company, I would have never thought I'd be in real estate ever. So, it's one of those things, just you never know where the path is going to take you. And it was all about me getting on my wife's nerves, started this empire.
Well, look,
so anyway.
I know we're going to talk about buy box, but I got to throw this news out there.
Yeah.
Did you see the article I posted in our investor Facebook group about how Open Door reported a $400 million loss?
Isn't that crazy?
That was a shock to them. It wasn't to us.
No.
Because they were out there overpaying for everything.
Yeah.
And then I saw that article on Real Deal website and I said, oh my goodness, Zillow just went through it. Now Open Door's going through it. So here's my question. How do you think that's going to affect the market as a whole when you have Zillows who lost hundreds of millions, now Open Door losing hundreds of millions?
Yeah. It's not going to affect us at all.
Okay.
Because they weren't buying in our market.
No.
Yeah, it was a major market play, meaning, Denver, Scottsdale, Las Vegas. So they were buying up homes in major markets. And it was really funny, they were in their little lane. They were doing really good, selling advertising, this sort of thing. And they were a technology company.
Yeah.
And then they this is Zillow and Open Door and several others, they kind of veered off and said, well, you know what, there's a whole bunch of money to be made in flipping these houses, either flipping them without doing any work or actually doing the work. And so they bought up all of this insane inventory. They overpaid tremendously.
Oh, yeah.
And now they're just dumping this. So if you're in a Las Vegas market, it's going to affect that market tremendously because you've got them dumping 1,000 houses.
Oh, yeah.
So it's not going to affect us simply because they were not here.
Gotcha.
But the larger markets, there's a lot of deals to be made there.
And that will then push those investors realizing that they're in an unstable market to come find a stable market.
Well, that's exactly right. Because all of a sudden, that was really good. Las Vegas is not the investment market.
Now they're in over here as a stable market. So now we need to talk about what they need to think about before.
All right. Well, hey, all right. Last week we talked about North Alabama, the various market segments. I think the progression, and you tell me because you are my expert. I think the next step in deciding if you want to invest in a market is deciding what you want to invest in.
I agree, because even though there's so many markets here, right? I mean, even though we're just little old Huntsville, when you really break it down in any market, we have what's called segment of market. Each market is good for certain types of investing, right?
Yeah.
And so for an investor to come here from out of state, or even an investor here in our market watching these videos, I think it's very important before they run out and they start saying, hey, Mr. Agent, or hey, whoever, go show me some houses. They need to know what they want, what they feel comfortable with. What do they like to do? What do they not like to do? I know some investors that only want to buy houses to make them look pretty and sell them. And I know some investors that do not want to even touch a rental house.
Yeah. Oh, yeah. Right? It's kind of me. Yeah.
Like they don't want to have anything to do with toilets, tenants, and trash. Right.
Yeah.
And so I think that's a good question that we have here today is, hey, if I'm watching this video and I'm new, or maybe I've done it, 1 or 2 over the last 10 years or so, what's my checklist?
Right.
Like, what do I need to think about?
Well, let's go over because you got single family, you've got duplex, triplex, quadplex, you got apartments, you've got
warehouse,
commercial
storage
space,
facilities, you got a whole kinds of assets.
Let's go one at a time. Investing in single family.
All right.
In this market.
Yeah. So if we're looking at single family houses, one door occupancy, you can either look at it from 2 angles. You can say, look, I can buy that single family and be a fixer, where I'm going to go in, fix it up, manage contractors, manage budgets, manage money, get to have a little bit of a decorative side of me to make it look pretty, and then give it back to my agent and let them sell it.
Right.
That's one path, right? And you got to ask yourself a few things if that's the way you want to go, which is, A, are you good at managing budgets? Like you better be good at managing budgets if that's the route you're going to go. B is, are you a problem solver? Because as you and I both know, when you get into rehabbing, you might have 4 that are great, but you'll get one that the whole thing feels like all you're doing is solving problems through that one, right? And so you got to ask yourself those questions. And if that is the case, and you're like, yeah, I think I want to do fix and flips, I think that's the path I want to go down, well, then that will help you decipher through the different markets where you need to concentrate at.
Right.
Now, also single family, you have single family rentals, right? Where you might want to go and say, look, I'm looking at just single family, not 2, 3s, and 4s, and not multi-units, not all the other type of cash flow assets, but I just want to buy, as Warren Buffett once said, if it was me, I would go out and buy 1,000 little houses and rent them out, right? Yeah. And that is that single family model. Just buy a bunch of little houses and just put tenants in them and rent them out. And there's nothing wrong with that. Just know you're going to have multiple roofs, multiple HVACs, multiple floors, multiple tenants, all spread out over the market.
Yeah. So let me stop you there. So if you are interested in single family,
there's 2 paths.
2 paths. You can either flip it, buy it, remodel, put it back on the market, and even then you can do different degrees. You can do
absolutely.
Lipstick on a pig, or you can do HGTV.
Yeah, or you can even add square footage. You could take a 2-1, turn it into a 3-2.
And the thing you have to look at is where is that property? If you are going to flip it, what's the market going to bring back to you dollar-wise? Right. How's the net? There's 1,000 little details. Yeah. The other thing is you're going to look at it as maybe a buy and hold. You buy it, you do a little bit of work, you flip, and the math is very different because, like me, I'm a flipper. I got to have a profit margin in there. I want my cash out when I sell it. But if you are a more long-term player, talk a little bit about that. You're going to have, you're not going to worry so much about the quick profit. You're looking at it over the long haul.
And you can pay more for them.
Exactly.
Because you're not looking at it from like, hey, I've got to make my 20 or 30 grand now, because you're looking at it from, well, what we look at it from is what is our true net operating income. And the reason we say true is because if you're watching this and you understand NOI, net operating income, that is gross rents minus expenses, but it doesn't take out debt service, mortgage payments, and all that. So we say true so that we really know what our actual cash flow is. Then we just take that number and divide it by how much cash we have in the deal, which tells us our cash on cash return. Define
cash on cash, because I get asked that a lot.
So cash on cash is a formula that we use to determine whether our money is making us money at a rate that we're happy with. So if I go buy a rental house, and let's just do some simple math, it's a $100,000 rental house. The bank's going to give me an 80% loan, which means I got to take $20,000 out of my pocket. Now, for all my engineers on here, I know there's closing fees and all that, but we're just keeping the math simple. I got to put $20,000 down. So that's $20,000 of my money's gone.
Right.
Okay. But now let's do the math. I rent this property out. I got management fees. I got expenses. I got reserve accounts. I got mortgage payments, taxes, insurance, and I'm left with, I don't know, let's just say $200 a month. Okay. So if I take that $200 a month, which is actually a true net income, and I multiply that by 12, then I have $2,400 a year. Divide that by the 20,000, which says that investment property is going to make me somewhere around 12% annualized cash on cash return.
Based on how much you put down.
That's right.
20 cash in, it's giving you this much cash flow.
$2,400 a year.
You do it that way. How is that involved with the 1% rule, which we hear so much about and don't see a lot here?
Well, the 1% rule affects your ability to increase your cash flow. Because if you're buying it at a 1%, the downside is that once you take out the debt service payment, once you take out the insurance and taxes and expenses and management fee, and you take out a reserve account, which is vacancy and maintenance repairs, you're left with not a good return.
Right.
You're just not. I was looking at, there's a company that does property tours here in Alabama, and they sell properties on this tour. And Tim, they sent me a pro forma of a property right here in Huntsville that they build. And this is no joke. I don't want to call them out because they're a friend of mine, but he ran all the numbers on here. And here it is. Ready? Cash flow on this deal is $175. Now, we would say that's amazing, right? Hey, that's awesome. But when I went back and I analyzed it, the rents on this was $1,700 a month. Okay. Guess what they had in here for management fee? Zero. So
meaning you're going to manage it yourself. Yeah.
Right.
You're not going to pay
from afar because they're bringing people in here from all over. Right. So if you have a $1,700 a month payment and you hire management 10%, that's $170. Yeah. Their cash flow was how much? $175.
Right.
So on this deal, giving it to management to take it over, you'd make $5 a month.
Wow.
And that's the 1% rule.
Yeah. you do a lot of coaching. Do you find a lot of your students, especially when they're new to the game, they're kind of surprised by the fact that they're not going to make $1,000 on every house every month, or because you watch these shows and these infomercials, and you're going to cash flow this and this and this, but at the end of the day, you're really not.
I think some of them do believe that because whatever they're watching or the shows or little clips on YouTube, it doesn't really go through all of the real expenses that they have to understand. And then once I share with them like the formulas and our evaluation sheets, it does open their eyes because they're like, oh, well, I didn't know that there was a reserve account. I didn't know about that. And then it starts to make the property more clear versus you go and watch some short video and it's like, oh, well, if you're paying $100 for it, it needs to rent for $1,000. That's that 1% rule. And they think that it's just going to work out. But once I show them how to actually underwrite the deal and actually look at all of the different scenarios, they learn real quick. There's more to the game than just a quick formula.
Yeah, I got you. All right, so let's move on from single family into, you want to go into multifamily, duplex?
Well, let's go the phases. So we went single family, one door. So now you've got to switch over and say, okay, well, I want to be a landlord. So if you're going to be a landlord, you've got the single family, which we just talked about, but you also have like the 2 through 4 units.
Right.
And the reason that you see a lot of new landlords run into the 1 to 4 unit rental portfolio is because you can still get just a general loan at the bank and it's not classified as a commercial because anything under 4 units, you can still just get a standard investment loan on it. Once you move to 5 units and greater, the lenders start to look at the properties a little different and start to classify it as a commercial loan, just to put that out there.
Right.
But you start looking at 2s and 3s and 4s, well, then you are starting to limit your ability to buy properties in our area.
Right, because there's not a lot of
and if you really look at our area, they're very centralized into certain little pockets.
Right, and why is that?
Because that's kind of back then when they were building them, where permits were approved for multi-dwellings on these lots. Now, I'll say this: if you go out by Oakwood College, I was shocked to see how many duplex. There's like whole neighborhoods of duplexes being built out there. And also I can tell you this, why we had such a massive boom on that 4 and under was because the entitlement process and the engineering doesn't cost near as much, especially duplexes. Duplexes, I can come in on a sheet of paper and say, here's what I want to build.
Right.
I go build a 4-plex, I got to have engineering drawings, I got to have blueprints drawn up. And so a lot of times they lean more towards that.
Yeah. Okay. What are your thoughts on the companies that are coming in, building entire neighborhoods of like 2-1s? No, they're not rent to own. They're just rental. Like there's one.
Oh, build to rent.
Build to rent. Yeah.
BTR.
Yeah. BTR.
That's the little.
I loved them in high school. Yeah.
BTR. Build to rent. I mean, I think that it's
that was a
smart
BTO joke, by the way.
Oh, I didn't
Bachman
even get
Turner.
it. I didn't even get it.
I forget you're younger than
I
me.
am.
Anyway. Yep.
I think it's a very smart move if you have the liquidity to
big cash play.
It is a big cash play, and you have the liquidity to sustain it to get off the ground, because a lot of times those BTR areas, they don't normally see a massive win for year 2, year 3 on those, but the longer they hold them, they get massive.
Yeah.
And you got to be able to have the ability to run that runway.
Yeah, basically what we're talking about is these companies that come in, build an entire neighborhood of 2-1s, 3-2s, and just rather than sell them, they rent them out.
That's right.
And have you been to the one down by the dairy, South Parkway? Nice little neighborhood. Yep. Got a clubhouse, a pool, the whole 9 yards. So if you don't want to live in an apartment or a duplex, It is. They're expensive to rent. But
it's a house.
It is a house.
It's
Basically,
a house.
that's what you're doing. So, all right. So we've gone from single family, multifamily. Where are we going next?
Well, so as an investor, if you're watching this, I'm hoping that you're saying to yourself, okay, this all sounds great, but I probably need to be thinking about what works best for me.
Right.
And that's when we talk about rentals, I just will say this, you will become a burned out landlord very quickly if you decide to self-manage.
Yeah.
And there's different classes that I want to be also clear on. Like there's a lot of little houses that you can buy out there for under $100,000 that produce a lot of cash flow, but it's got a lot of heavy maintenance and a lot of management. So you better get a good management company. So you got to get that in place to handle that. Now you move into, the $200,000, $300,000 house pricing. Oh, it becomes a lot easier to manage. It doesn't have as much maintenance issues, but you don't make as much cash flow. So they're different plays. But once you move out of the 1 to 4 unit, well, now if you're a landlord, there's so many other asset classes, right? Like you could say, well, look, I really want to go big time. And so big time could mean people with capital, you've got banks in your pocket, you might have, reserves put away. You could move into larger apartment complexes, 10, 20, 40, 50 units, which are very difficult to find right now.
Yeah.
You could move into storage facilities. You could move into mobile home parks, RV parks. You could move into STR, short-term rentals, where you're buying really nice houses. There's so many. I mean, we could spend hours going down all these paths. But also, you could develop storage facilities. You could develop warehouse spacing. You could lean more into the business. So for me, I have found, even though I own a lot of rent to owners or tenants or just people in general, I have found that when you run a model where you rent to businesses, oh my goodness, it's so much easier.
So much easier. Yeah.
They sign 3-year leases with rent accelerator clauses, and you don't have to worry about hardly anything.
So you like commercial?
It depends on what class of commercial,
okay.
right? Commercial is a big term,
okay,
right?
Explain.
And, well, people will say, oh, commercial, but under commercial, think about what all you have. You've got strip centers, you got shopping centers, you got malls, you got warehouse space, you got storage facilities, you've got, I can't think of all of them, but there's just so much that falls under commercial. I personally like warehouse space.
Yeah.
I like building warehouse space and then leasing the warehouse space back into the community. And typically the avatar or the tenant that we look for is like the electrician, the plumber, the cabinet maker, the car enthusiast that needs a place to put all of his cars in. And so we just don't have enough of that space in our community. I mean, we build warehouses here, but it's like 50,000 square foot warehouses. Yeah. And the backbone of our economy, the blue collar working business guy that's starting and growing his business, they need 3,000 to 6,000 square feet. And we just don't have it.
I want to go back to something you said, because if you're thinking about investing, there's a lot to think, not just the investments, the product, but you got to look inside a little bit too. You look at the man or lady in the mirror and go, okay, what is it exactly I want to do?
That's right.
Do I want to do flipping? I'm a flipper. I just like to do that and move on. But is my goal to build a portfolio of rental houses?
Right.
Is my goal to eventually, syndicate? How big do I want to get? And there's an old term, my mom used to say this all the time: don't let your eyes get bigger than your belly.
Oh,
eat what's on your plate, right?
Yeah,
so what's your advice? And I know you've got tons of coaching students. What do you have to tell them, okay, I think it's really great to be ambitious and, I want to do, but for right now, what do you tell them?
You're saying.
Yeah.
Because they're all different, right?
Yeah, they are.
But, for me, I'm really big on building long-term wealth. And so I do rehabbing and flipping to feed my end goal, which is buying more long-term wealth. So my goal in the market is I don't want to be the biggest and the best rehabber. My goal in the market is I want to find really good deals. I want to have a good machine that flips them to feed my end goal. What you said earlier, what do I look in the mirror and want back? I want legacy wealth. And that's what I want to build. So when I'm meeting with people and we're sitting down, one of the very first questions that I always ask is I say, hey, look, let's get clear on intention.
Right.
What is it that you want out of this? you know, and a lot of times you'll hear them say, well, I just want to make some money now, blah, blah, blah. And I'm like, no, that's short-term goals.
Right.
What is the long-term goal here? Like, what is it you really want to do? And then I work backwards from there. So I'd say 80% of them all want long-term wealth.
Yeah.
And 20% of them just want to wholesale or do rehab.
Yeah.
Right.
And it's your job to help them get there.
Then we work backwards from there. Okay, what are we working with? If this is who you want to identify as, and this is where we want to keep our vision at, well, then we don't want to lose that vision, because trust me, the path to get there is up and down, sideways, left. It gets very complex, right? So we have to keep that to the forefront, but then we have to work backwards from there and lay out a plan, like pick your market, know your investing strategy, identify where the money's coming from, and then start building your team, right? And then work through the other pillars to investing after that.
Are your new students always surprised at how much work there is to do this?
I mean, I tell them constantly when they're, because they'll call on the phone, they're like, I'm so excited about this. And I'm like, well, tell me that in 45 days.
Yeah. Let's revisit.
Right. Let's revisit how excited you are.
I get a lot of calls from out-of-state investors who, you know, I work at Google in San Diego. I've got $200,000 in my 401k burning a hole in my pocket. I want to take that money and invest. And, you know, they're looking for us really to kind of give them some guidance.
Right.
And the one thing that I've noticed is our market's very different than a lot of markets that they may already be investing in.
That's true.
And their buy box, their strategies, they're not going to work here.
Well, it depends on which market they're in, but I understand what you're saying. Like what you might do in Atlanta or what you might do in Knoxville or Memphis or Jackson, Mississippi is not going to be the same here.
When they call me up and say, I typically buy houses at $30,000, $40,000.
Well, tell them to go to Birmingham or Montgomery
or
somewhere like that. They can still find those, but they're not going to get the appreciation or the quality that we have here.
And that's a trade-off, I think. You mentioned that in the riskier areas, the return is greater.
Oh, yeah. Look, I built my career 21 years ago buying all these little $17,000, $20,000, and $30,000 houses, right? But I went in with a very clear understanding that my mentor taught me back then was look, you might start here, but you're not going to stay here.
Right.
And so it was always a 2 to 5 year plan. I wanted to get in, grow my capital as fast as possible because the returns on those little houses are insane. But it's high maintenance. Like you got to be managing the managers on those things. So it's a trade-off, right? And then we started selling. Now I do kick myself a lot because a lot of those houses I bought were up in West Huntsville that are now selling for 180, 190,000. So
yeah, that's the new area. I think that's where things are.
And I own so many up in there for under 30 grand.
Yeah.
And now I'm like, man, I should have kept those things.
One thing you mentioned is, you look at you've got a 3 to 5 year plan. From where you started, I mean, you've ended up in when you get started, you had no clue you'd be here today doing what you're doing.
No, 21 years ago, no.
Yeah. So talk about you have to be flexible and change. Oh, yeah. You got to change horses every now and then because the one you might be on, you might want to just shoot.
Yeah.
Or you've worn it out and you need something better. So
well, and I talk about this a lot. I say, look, as investors, we have to understand something. We're moving parallel to a real estate market. So we have to be able to pivot as the market pivots. And the only way that you can pivot and move with a market is having more than one type of strategy, right? Because you can't just go into a market and say, this is the only thing I'm going to buy and this is the only way I'm going to do it, and think when that market shifts that you can stay in.
Right.
And so we have to be able to pivot and shift. Just like me, when I first started out, I didn't know any better. I started out as a wholesaler because I thought that's the only way I could get in. I didn't understand all the other things. Well, very quickly, I realized, well, man, the real money was in rehabbing. And so then I went and got specialized knowledge, started learning rehabbing. And then I was like, man, I'm still working for my money. I need to start building cash flow. So then I went and started building, rental portfolios in cash. And yeah, it changes constantly. And for a few reasons it changed because not for everybody. Let's be clear on this. Because some people, they don't want to do what I did. Right. They just want to buy a few houses and be happy. And their model is fine, right? But then others want to keep growing their education. They want to keep learning. And that was me. I was a seeker of information. I didn't want to just stop at this plateau. And through that endless desire to keep learning and identifying new ways to invest in real estate, it just started exploding my business because then I could look at deals from a different light. I could look at them and restructure them and be like, okay, it may not be a deal this way, but if we did this, this, and this, now we've got a deal. And that just came from just pursuing knowledge and how to be better at real estate.
Yeah, and to be flexible and to change, and you have to go with the market a lot
all the time.
Yeah. How often do you wake up and go, "What have I done? Why don't I go do something else?" You ever have those moments, or you dug in pretty deep by now?
Not with real estate. I mean, I've done really well with real estate. You know what I mean? And so I wake up all the time and just say thank you, because I'm very blessed that from where, if people knew where I came from, like, it's just, I'm thankful that I stayed in with the tenacity and the drive. But I don't ever question it, right? What I do question sometimes is all the other business ventures I go into, because I get all these high hopes for them, and I'm like, man, why am I doing this? Let me just go back to real estate.
Well, you get to a point where you just kind of chase a new squirrel.
Oh, that is so true. And we've had many conversations.
We've chased a lot of squirrels in our time. So, all right, so let's sum up. So there are different kinds of investments: single family, multifamily, warehouse, commercial retail, all kinds.
And there's private lending.
We're going to talk about lending on the next show. So
love it.
Can you hold that for a week?
I can.
You're doing good. Any final thoughts?
Well, based on today's podcast, videocast, I would say my final thoughts is this: don't rush in. Just take a breath, take a minute, and just do a little bit of self-reflection. You know what I mean? Like, because you don't want to just get enticed to go buy a fix and flip if you haven't talked to your family, your spouse, your children, and say, look, this is what I'm about to go do. And we're going to have some highs and lows, and it might take away from my time with you as we build this model out. You need to have everybody on board.
That's a good point. You're not doing this alone.
You're not.
You've got a family. It affects them as well.
Oh, everybody. Yeah, everybody. Because not only is it affecting them by time and commitment, but your stress feeds off on them too. But the biggest thing it affects is the financial side of the family. So.
Yeah. And if you dig that hole, you got to know when to fill that dirt back in.
Well, yeah, because everybody's going to point the finger at you.
Of course. What were you thinking, Tim? I mean, Bob?
That's it.
All right. Good information. Hey, if folks want to get in touch with you, talk about your coaching, talk about investing.
Well, I think the best thing is if they want to know who we are and what we do, I say it every time, just come by our Facebook group, which is the McREIA Group, MRMCREIA Group.com. Or check our website out, MadisonCountyREIA.com.
Yep. And Zack also has a lot of videos and a lot of free information out there
on the group
that they can take advantage of. So, all right, guys, that's going to do it. Tim Knox with Revolved Realty. If we can help you in any way when it comes to real estate, don't forget to reach out. My contact information is below. And so next time, I think we're going to talk money.
Oh, I love that part of it.
Yeah.
I'll break it down into 4 different quadrants of money that all investors should either have in place or be working towards to get. Bam.
He's going to bring in a sack full of $100 bills. So, all right, guys, that's that. Get out, make it a great day. We'll talk to you soon.